Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. I've got some good news, y'all. I know that last week everybody was talking about recessions and bear markets, and it's the worst half of a year since 1970. I talked about it as well. However, just because the first half of the year starts bad does not mean that the rest of the year will continue on that track. It is no guarantee that because you are down in the first half of the game that you are going to come out and continue to lose the game. You can ask the Atlanta Falcons about that. All right, so y'all, if you know, you know, okay? So I'm going to give you 2 key stats and give you a frame of reference and a frame of mind to remember for the second half of the year. And I've got a few things that can really help you become a better investor should these patterns continue. Now, obviously, history, it might rhyme, it might, but there's no guarantee that things are going to go in any direction. But here's the stat, here's a headline here. Every time that the market has been down 21% or more in the first half of the year, it has ended up being positive by the end of the year, meaning the second half, with a more clear way of saying that, the second half of the year turns out to be positive. So we have 1932, 1962, and then 1970. Those are the last 3 times that it happened. Now you may be thinking, well, what about 2020? Yes, 2020, the market was down more than 30% and then rebounded and was positive before the end of the year. But it wasn't just the first half. We're talking about January to June, the entire half. Was it positive or negative? And if so, was it positive or negative by 21% or more? Okay, so in 1932, and I will put this here. So 1932, the first half of the year was negative 45%. The second half was positive 56%. Okay, that's one. In 1962, the first half was down 23%. The second half was up 15%. And then in 1970, the year everybody was talking about, it was down 21% in the first half and up 27% in the second half. Now, none of these, there's 2 things to know here. None of these are predictors of the future. 2022 is different. Okay, we don't know what is going to happen. And I'm not banking on all of this occurring, but I am doing something specific, which some of you may already know. Should this thing work and should this thing be true, we're gonna be all right. Okay, so stick with me. Now I have another stat that you also need to know, and I will put this here. And this is from Bank of America via Fortune magazine, Fortune website. So Bank of America has noted that historically a negative first half of the year usually means that the second half is also going to be negative over the next 6 months. I always talk about that 6-month thing, right? However, the S&P 500 has led to negative returns for the index for the following 6 months, some 44% of the time. So when the first half is negative, there's a 44% chance based on their data that the rest of the year is going to be negative. Now, 44% is a big number, but it is not the majority. And again, that does not account for how big that percentage is. So when we say 21% or more in the first half, the last 3 times this happened, the market, the second half of the year, the market was positive. Now, there's one other caveat before I get into some strategies here. If, let's say for 1932 was down 45% and the second number was 56%. So if we're just doing mental math here, if you start in January with $1,000, you lose 45%, you have $550 left. Whew, not fun, right? And then if it goes up 56% from there, you're back at like what, 850, let's call it $858 or something like that. So you're still not positive for the year. So remember, math and percentages, right? So it doesn't mean that the end of the entire year will be positive. It just shows that historically, for those cases, the second half was positive. Here's the thing though. In the example I just showed you with $1,000 that we just kind of walked through, that's $1,000 one time from the beginning of the year and not touching it. You end up better if you're dollar cost averaging. And assuming here, again, not a guarantee, assuming that the market is positive for the second half and you're dollar cost averaging, your returns are actually going to be better, assuming that that is the case. So dollar cost averaging does help you out. Also, when I talked about this whole 6-month thing, there is a reason to it. There's a lot of research behind it. Again, it is not a guarantee that just because you do something for 6 months means the next 6 months are going to do X, Y, and Z. It is not. However, it does give us enough time to make adjustments and move your portfolio in the right places to succeed. That is why we do it. That is why I talk about it. Is why I talk about it in the members only and everything else, right? So the lesson to learn here is, and you can even learn this from today, and there are a bunch of lessons the more I start to think about it. So number one, of all the years that I mentioned, it was only three: 1932, 1962, and then 1970. Notice all of those were better, or exactly where we were, or worse. So a lot of people, maybe you just started investing and you're like, oh my God, it's the worst thing ever. We've actually been through a lot worse, or at least equal. So 1970 was quote unquote equal. The 1930s were way worse, and 1962 was a lot worse, and we still were able to recover. Also from 2020, while it was not the first half, January to June, from February, March, and April, the market had dropped more than 30%, and then by the end of the year, things were fine. The market was up double digits that year. So things can return, things can bounce back rather quickly. I am not expecting that to happen. However, I am still investing and staying the course. I'm not letting this moment in this first half of the year shake me off of my goals and my research and everything else. And you can go back to the videos I did in 2020. I didn't think it was going to recover that quickly then either. And so I'm staying very consistent here, and I am preparing, as I always do, for what I think is the most likely scenario, and let the chips fall where they fall, and I'll adjust in December. So I've already prepared. Should inflation still be a thing? We'll find out this year. Should recession be a thing? We'll find out this month. Should earnings do X, Y, and Z? We'll find out this month, right? We're going to find out all the things in July. But in either case, I position my portfolio in a certain way. We've talked about those moves. I've been talking about defensive stocks and dividends and healthcare companies and all those things I've already discussed. So I'm sitting here and saying, look, it might not be all bad. Even if it is, we know, given the last few times that this thing has occurred, right, that if there is a recession, it's going to last on average 18 months. That is an average, okay? In 2020, last time we had a recession, it fixed itself rather quickly. Hopefully we don't have any recession, but if it does, 18 months is what I'm expecting. If it is shorter than that, perfect. If it's longer, hey, we deal with it, right? The other thing too is we know a bear market lasts 363 days on average. Bear market in 2020 was over rather quickly. We're talking like 45 days or something like that, and it was done. It was over. So hopefully, the second half of the year, we're done with this whole bear market thing, and the market is positive. That's the best case scenario. I'm investing for either case, right? So, and when I say that, for example, y'all have noticed, at no point have I ever considered selling Microsoft or Google. If this is not a bear market and things continue in this direction or in the right direction for the second half of the year, Google and Microsoft are going to be at the top, near the top of companies that do well. That we already know, right? They've been doing that for decades. It's one reason why I continue to keep them. I even kept half of Amazon, sold half of it, kept the other half in case that were to happen. So a portion of my portfolio is positioned for the best case scenario. Then I've got a portion of my portfolio that is positioned for the worst case scenario. Still kept Danaher, which is a healthcare company, pays an okay dividend. I've got T-Mobile, which I think will do good in either scenario. I think it's kind of an all-weather stock right now. Added Dollar Tree. If a recession is going to come and things are going to get rough, Dollar Tree is one of the places that tends to do well historically. So each stock in my portfolio is positioned to, for a good weather day, things go well and surpass my expectations. Things where it's just medium, and I think it's going to do good in any scenario, like a T-Mobile. And then things that if it is bad, then I've got a few stocks to help me out and perhaps even do well in that type of environment. That's what we mean by creating diversity, diversification. I guess diversity and diversification, almost the same thing. But having diversification in your portfolio, and also planning and making sure that you have what your scenario, what your thought or your hypothesis is, and making sure that your portfolio matches with that. So you want to make sure that you have those things. I know I'm using my hands a lot, which I always do, but making sure that what you think could happen and may happen fit with how you're investing. What you don't want to say is, well, I think there's a recession coming, but all you have are really unprofitable tech stocks. And I look at your portfolio, you have Peloton and Zoom and Pinterest. That's not a recession portfolio. That is I hope the world flips and everything is the greatest utopia ever, and we go right back to, you know, pandemic stock market where everything was jumping. That's not the case, right? So I hope that for you, that the market goes up, and whatever you're investing, I want everybody to make money here. But the good news is the second half of the year is not lost. It is an unknown, since none of us know what's going to happen in the next 6 months. But there are some stats, some data, and some figures that say, hey, there is a chance. And for investors, you want to make sure that you hold steady, because again, you saw what happened. We all saw what happened. It wasn't nice. But if you sold and got out of it and you were not prepared, then you might not, keyword, might not benefit from what could happen in the second half. But in either case, you need to make sure that your portfolio is positioned for all weather, right? We had 6 months of data, make some adjustments. I've already talked about what those adjustments could be and what adjustments I made and more. We're also going to talk a lot this week about doing some company breakdowns. I want to grade somebody else's portfolio, so if you want to volunteer and you're on public, drop your public link below and you will be entered into a drawing for who gets graded next. But all those things are out there, okay? Keep the faith. It ain't over yet. The game ain't over yet. It's just halftime. I think there's a lot of space for the market to grow. There are a lot of positive things that could be around the corner. And don't be ignorant to the fact that there could be some negative things around the corner as well. Your job is to work your plan. My plan, y'all gonna see me on Friday, I'm investing anyway. Because if the market comes back, I'm gonna benefit from these cheap prices, right? If the market continues to fall for the rest of the year, I'm gonna benefit from these prices, right? Because we know the market tends to rise over time. So just wanted to zoom back, give you some of that data and insight, and just show you that, hey, it's not over yet. I know it's hard to see when you're in it. It's hard to see when the market is down, but zoom out, take a step back, take a breath, and if you are still investing, you might be all right. All right, that's it for me. Make sure that you hit the join now tab. I'll put those links and things around the screen as well in the description below. Talk to you later.